what does it take to be a better trader? I can tell you this, I can give you some answers to this because I haven't made millions or multi-millions in trading, so I can tell you what it takes. Some of the things that I don't have, some of the things that I have experienced, I want to share them with you. And by no means is this Bible. No means is this the way to do or not to do anything, but it's been my experience and I'd like to share it with you. And I think it'll apply to anyone. And let me just give my disclaimer. I am not giving you advice, any kind of trading advice or anything like this. I'm just sharing with you what has worked or what has not worked for me. Okay, so let's get right to it. One of the first things that you want to do if you want to be a decent trader is to focus on the long term. You know, I have tried the day trading and, it gets me in trouble every time. I mean, it's fun, it's exciting, it's exhilarating, and yes, it does work for some people, but statistically, day trading don't work for most people. When you look at long-term trading, if you stay in a stock more than a year, there's some benefits to it. Number one, the S&P, which is a example of the market. You have the Dow, you can look at that. You have the S&P. There's areas of the market, the NASDAQ, that you could look at for a long term that gives you a general idea of how the market is doing. Well, the S&P is the one that people look at most often, and whether the market is up or down, they'll look at the S&P, which is a collection of approximately 500 stocks that major companies are in that particular division of the market. And we look at that and we say the market is up or the market is down because it's that good example. Well, over the last 10 years, the S&P has on an average traded above 8%. Actually, I think it's more like 10%. The market has really done good over the last 10 years. But if you look at it long term, an 8% growth rate would be the average. So if you stick your money in the S&P, if you chose the same stocks that are in the S&P, you would have seen at least an 8% gain over the last 10 years. So that's one way of trading. But my point was to focus on the long term. If you look at if you pull 1 year out, if you trade it for 6 months or 1 year, you may not see the 8%. But if you stayed in, 5, 6, 10 years, you're most likely to see the 8% growth. Number two, learn to embrace your failures. One of my things in my day trading, my personal account that I trade for myself, I have a history of picking the right stocks. My daughter and I, we laugh about this. We picked the right stocks, the stocks that if we had stayed in it for a year plus, we would have most likely doubled our money. We choose those kinds of stocks. We were in Google, we were in Nvidia, we were in Amazon a year ago. And we were jumping in, jumping out, jumping in. What's the next best stock? Jumping in, jumping out. And we didn't do as well as we wanted to do. But if you looked at that over the last year, especially the Nvidia and Amazon, we would have doubled our money. So, staying in the long term would be great. But this example here is about embracing your failures. And my failure was ignoring what I know to be true. If you stick to it for a while, you're going to actually make the money. You're going to make the 8% plus. And I didn't do that. Another thing that I did, in day trading, I like to jump in stocks and, sometimes I fail to put in what they call a stop loss. A stop loss in stocks is, for example, if you buy Amazon stock, you can set a stop loss that says if it goes down the negative direction, for $2 or $3, you automatically, that stock sells. It doesn't need your involvement, but if it moves the opposite direction, it'll automatically sell, get you out of it before you take a big loss. Well, that was one of my mistakes that I don't want you to make, so I wanted to share that with you. Another thing is being diversified. Don't throw your eggs all in one basket, as they say. Be diversified. What does diversification mean? You may have some stocks that are in the tech field, like the Google, the Amazons, the Nvidia. Have a few stocks in retail. One of my favorites in retail over the last year has been Abercrombie and Fitch. or you might be in some real estate stocks, or or have a little bit of your funds in an actual index funds. Index funds are great. That should be a whole conversation by itself. You can choose an index fund, which is a collection of stocks that could be all in one area, one field, or it could be a mix of stocks depending on which index fund you choose. But someone is managing that fund, and then you're buying a piece of that fund. The next thing is to focus on value, not just price. Sometimes, some of those smaller stocks, those $5, $10 stocks, they make major moves. A stock going from $5 to $6, it's a 20% jump in your money, and you've made a lot of money if it goes from $5 to $6. But typically, those type stocks are also volatile. They can also go down 20%. So a lot of people like investing in value stock. And I'm not saying that a $5 stock can't be a value stock, but typically when people talk about value stocks, they're talking about stocks such as a Walmart or an Exxon Mobil. Those might be considered value stocks, stocks that have a history, and they're typically not volatile. They move in one direction. I got a little bit of Walmart maybe about 6 months ago. I don't remember the exact date. Walmart was I think like $60 or something like that. And, I'm one of those people, I like action. I like to see movement every day. And Walmart is not one of those stocks that move every day. Well, at least not big moves. It might move 5, 10, 20 cents, but nothing big. I like the Amazons that float around, $5 today, $3 the next day, some nice movement. But Walmart is considered a value stock. Now, since then, in that 6-month period, it has gone, I think, from about $60. I think today is probably around $72, $73. Good money. And Walmart is a dividend stock. So that is considered a value stock. Over the years, Walmart has done well. The next one would be to make educated decisions. Don't just, like I have done, and I'm guilty of it. A couple people on YouTube or television, they're talking about, oh man, this stock is taking off. I love this stock. It's doing this, and it's a lot of hype. Seems like everybody's jumping in it, so you want to jump in it too. Don't do it. Educate yourself as to how you want to invest, what you want to invest in, and stick to it. Stick to what works. Mentioning sticking to what works, a lot of trading platforms have a system where you can actually use play money. You can make investments and see how your method of trading is going to function, how it's going to work, whether you're going to be successful at that method. And if you're a new trader, I really recommend you doing that. I did that for probably 6 months to a year before I actually started trading years ago on my own. The next one is to stay flexible, be adaptable. The stock market, we can turn the news on today and they could say, there was a school shooting in Texas or wherever, and something as simple as that can shift the market. Probably not shifting the market enough for you to say, I'm going to get out of the market today. But there are some things, when they talk about the economy, we're in recession now. If they said that, you might want to consider, fortifying your portfolio. Either getting out or making sure you're in some of those value stocks that are not going to plummet. Or watching, CNBC, and if they will say that, there's a legal issue happening with a particular company. I remember about maybe a month or two ago, NVIDIA, there was some news about NVIDIA, that wasn't good. And it had a, pretty big hit, or gave a pretty big hit to NVIDIA. So being in tune, if you're trading for yourself, you want to be in tune to what's going on in the world. And I don't think I mentioned this when I talked about making educated decisions. There's two ways that I look at stocks. For the most part, I make decisions on my stock choices based on charts. I study the charts and where a stock has been, what does it do in certain periods, how it's moving, and that's how I make my decision as to whether I'm getting in, getting out of a particular stock. Well, there's another method, which is studying the fundamentals of that stock, how that stock has done over the past, the earnings on that stock. That may be your method, but whatever that method is, use it, stick with it, and make your decisions based on that. That's an educated decision. Next step, or next thing that I want to tell you about, is controlling your emotions. Don't get too excited. You might see your stock move up. I was in Nvidia when Nvidia was at approximately $300, and it took a big move. It moved up like 70, 80 bucks in one day, and I got excited and I dumped more money in it, and it didn't move anymore. It didn't move for the next 6 months, but I didn't stick with my plan. I actually pulled money from a stock that was actually moving to get more into Nvidia. That was an emotional decision. Try not to make the emotional decisions. And the last one I want to share with you is reinvest versus spending your gains. When you sell a stock, don't just pull that money out when you've made money with it. Don't just pull that money out and go buy, some concert tickets or the latest shoes. Reinvest. Put that back into something that's going to generate you some money, whether it's back in the stock market or whether it's in real estate or some other asset. But reinvest your money so you can take advantage of that compounding effect. Keep putting it in there. Keep putting it in there and watch it grow. All right? So I hope this information was good for you. Please like, subscribe, and share. Be blessed.